I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us for this December 8th version of the Market Carver, where we're going to talk about a few things this week, all across the board, as is per usual. We're going to talk about the global yield curve, always an exciting topic, but it packs a big punch. We're talking about the unemployment cycles and what that may mean in terms of challenges for the Fed. Andrew's going to talk about and give us an update on the number of new highs and its importance. And then lastly, look at the S&P 500 and that technical indicator of the 200-day moving average. So we'll jump right in on the global yield curve being inverted. So it may look like an intimidating topic or sound like a bit of technical language, but all we're talking about on the yield curve is simply that bonds or interest rates have different time frames. You could borrow on a 1 month or a 10-year or a 30-year time frame. And so the yield curve simply plots interest rates along those different time frames. What we're looking at specifically on this chart is the difference between the interest rate on a 10-year note and the average of a 1 to 3 year yield. We use an average because here we are looking at global interest rates, not just the US. So the really interesting development is here in the US, and we've hit it several times here in the Market Carver if you've been with us. The yield curve in the US has been negative and has moved more steeply negative. That has now moved across the globe, and we have a really rare instance of it being inverted across the globe. That means that all the central banks, not just the Fed, are very aggressive in terms of raising interest rates. And so just to bring it all home, what this means in the US is that as of Friday's close, you could buy a 10-year U.S. Treasury note for about 3.5%, a yield of 3.5%. On the other hand, you could go for a 2-year note, and that yield was 4.25%. It's supposed to be the other way around. If you're going to take a 10-year amount of time for risk, you should get paid more than you do for the 2-year. Instead, you get paid a lot more interest rate for taking that shorter term note. And that is what can usually cause, in the past, recessions. Rather than taking risk and going out for a long period of time, people just can shrink up and get a higher interest rate over the short term. So this is really something that we've got to contend with. Market doesn't mean that we have to go into a recession, that markets have to struggle. They traditionally have, but all eyes are towards this uninverting going forward. That typically means healthier markets. Next, staying in the same ballpark, and one of the things that the Fed has to contend with. So the reason that's inverted is they're having to jack up interest rates over the short run because inflation has been stubborn. It's not coming down. And so part of the Fed's strategy is to have unemployment go up. In their thought process, if we could loosen the employment markets and loosen some of the competition for labor, we might see inflation continue to come on down. This next chart really highlights what the difficulty in that is. And rather than look at any specific time frame or any specific level, what I want you to look at in this chart is the way it typically works. All right, it typically not just kind of takes staircase or some sort of pattern. They go up in spikes. So this is a chart of the unemployment rate. And what this shows us is that when the unemployment rate begins to go up, it tends to finish the job and spike and go higher. And this makes sense if you just take a second and think about it. And this is so important for the challenge we have ahead of us. That typically means if you have unemployment go up just a little bit, and think about what happens, that means you have more people obviously on the unemployment line. So the economy gets a little bit softer, which causes people to get more cautious and to pull back. And that can cause more companies to tighten their belt and cause the unemployment rate to go up more, which feeds the cycle. So it's a very self-fulfilling cyclical type of process that we work with. So the Fed strategy or their hope is that they can lift this just a little bit without breaking things to help bring inflation down without it unraveling. And this shows us there's not really historical precedence. That doesn't mean that one can't happen. But that is truly the challenge that we have facing the Fed, and why economics and why we don't pay attention to forecasts, because human behavior is all over this chart. And there's no really telling how it unfolds or how high it goes. It's such a difficult phenomenon because it is certainly a possibility that we don't have it go up at all. Time will tell, but that's really what all eyes are for, especially as we go in the next week where we have yet another Federal Reserve meeting. So enough of economics and that talk, Andrew. We're going to hand it off to you and look at the market and what you're saying in terms of the technical side of things.
Yeah, so a topic that we look at just about every week in our weekly allocation meeting, and something we often bring in this market Carver video, is looking at what's the market doing below the surface. We often talk about the indices, the Dow, the S&P, the Nasdaq, but we always want to be cognizant of what the individual stocks are doing. Are they making more new highs? Are they making more new lows? How healthy are as the market from an individual stock perspective? So the first chart, we'll throw it up on the screen here for you, is looking at the number of new highs, specifically new 6-month highs for large cap equities. So before we can start even talking about 52-week highs or 1-year highs, we first need at least to start having some 6-month highs. So that's a good place to start as we see the market begin to recover off those October lows. So for the first, we now have the highest number of 6-month highs actually going back to January. So this chart here goes back all the way to 2017. And we can see that when we have less and less new highs, less and less participation in the uptrend of the overall indices, then that can cause some trouble. We saw it back in 2018. We actually saw it before the COVID crash. And then we saw it, and it was a topic we discussed quite a bit last year, as fewer and fewer stocks were making new highs while the market was going higher. Now that we've seen the market have some volatility and go down, we want to start seeing that improve. And we are starting to see a lot more stocks make new highs. In fact, just about a quarter of the S&P 500 has made a new 6-month high last week. So very encouraging sign. That's exactly what we want to see. We want to see this continue, hopefully in a year end and into the next year. That's what gives us confidence that we can start seeing risk start to increase across the market, risk appetite go up, and start seeing a lot more bullishness into this market because the individual stocks are starting to rally. Now, another way we can look at that is specifically looking at how are stocks trading to a long-term moving average, basically a smooth version of their stock price. And that's what this next chart is going to look at. Specifically, how many stocks are trading above their 200-day moving average. And what we have here is we've seen a really good improvement here. But what stands out the most is when we go from a very low level, when we have less than 15% of stocks that are trading above their long-term moving average, and we get all the way to the level that we were at over 60% as of last Friday, typically that's been very positive for the long-term stock trend. You can see back in coming out of the dot-com bubble, the financial crisis, and then several smaller declines since then, that when we've seen kind of this washout, all the stocks are going down, and then we start seeing that improvement back to, like I said, 62% of stocks are now back above this long-term moving average, has been a positive for the market. Now, we are seeing markets pull back this week. As we record this on Tuesday, we've seen some weakness on Monday and today. We don't want to get too caught up in some of the shorter term struggles. We do want to continue to watch support levels and really see how the market acts and responds at different points in time. But the internals of the market right now are very much improving, and we're very encouraged to see that, and hopefully it continues to be so. Now, we obviously don't know what's going to happen going into year end. If this data does start to worsen, then we'll have to shift some things around and maybe change our outlook. But right now, things are improving, and we're very encouraged by it.
Yeah, that's very good, and I think your message there dovetails with the conversation I had just this morning at breakfast with a couple of colleagues in the industry, and they asked us what our outlook for 2023 is, and I've done business with them long enough. I kind of had to stop and give them the deer in the headlights because I figured they knew we don't bank too much onto a forecast. The idea is that we don't marry in that we've got to be nimble. So things are looking good now. We're fully prepared to adjust as time. That catches some people off guard in the industry, as you very well know. We're expected to have an outlook and say what we think will happen in the markets, and we certainly have those. We just don't invest based on it. So the idea, as always, is to remain nimble. So thank you all for giving us this time. We give you a weekly reminder to please come in and see us. If we don't have the pleasure of working with you yet, we'd love to have you come in and see us. Call us 800-928-4001. And for those of you that do, we appreciate you so very much. Appreciate these few minutes of your time, and hope you all have a great weekend.